Nvidia is one of the most popular retail investor stocks. The stock is down 8% year to date, is literally trading at 19 times earnings. I never thought I would see Nvidia at 19 times earnings. But the question is, why is Nvidia trading at 19 times earnings? Is the market really so irrational? Is everyone making a mistake and it deserves to trade at 19 times? Or is 19 times actually a steal for Nvidia? I believe market participants have two main concerns with the company. The first one is the sustainability of the growth. Nvidia has grown data center revenue exponentially. It's over a $3 trillion market cap, bigger than a lot of GDPs of most countries. So how sustainable is the growth? The second question is, how sustainable are the inflated 75% gross margins for Nvidia when you have AMD entering the space, you have AVGO and Marvell and custom chips and other companies are entering the space? How sustainable is this 75%? I'm going to answer both questions in today's video and give you my valuation model on Nvidia. So I really hope you enjoy it as always. Now, the first one, I want to start with reading what Jensen Huang said when he was asked about how sustainable is this 75% gross margins. And he said, if we can deliver performance per dollar dramatically more than the cost of our systems, than the price of our systems, then we can continue to sustain our gross margins. That's the simple, most important concept. And this is what Nvidia is focused on, which is mainly performance per dollar. And ultimately, that leads to more token, and that ultimately leads to more revenues for a lot of the hyperscalers, especially in the inferencing cycle. But I believe the biggest concern for Nvidia is a lot of the competition from the in-house chips like AVGO and Marvell. Google has their own chips, Amazon have their own chips. Meta, I believe, is looking into creating their own chips. Even ChatGPT wants to do their own chips. So this is becoming more and more popular. And this is, I believe, the biggest concern for investors. But Morningstar had a very interesting analysis on why they give Nvidia a wide moat in this matter. And they said Amazon and Google may use Trainium and TPUs to train their own AI model, but we think they may struggle to encourage a host of enterprise customers to optimize their AI models for these in-house semis. Doing so would prevent these companies, these enterprises, customers, from switching amongst cloud providers. And enterprises are typically loath to be locked in a single vendor, which means a lot of them will be demanding some kind of a neutral chip manufacturer. And this is where they see Nvidia remaining as the head of the pack for quite some time. So maybe Google and Amazon and Meta and all of them, they can use their own in-house chips to train their own model. But if they want to do it with workloads for other companies don't want to lock in all-in-one provider. If they want to have some autonomy, some flexibility, they will likely choose a neutral merchant for GPUs, and this is Nvidia or AMD. Most of them are already on Nvidia through CUDA, and that gives the company a competitive advantage. So even though the in-house chips are much cheaper, most companies in general will want something that's neutral. They don't want to be locked into one provider or cloud provider. So ultimately, they're going to still be choosing Nvidia or AMD. And I believe that was a very interesting take. Now, in terms of the growth, I'm very surprised by Nvidia's networking growth from 3 billion to 11 billion. And Jensen Huang is guiding much, much more for networking. But the big event recently, mainly in their conference, they guided Blackwell plus Rubin, which is the latest chip, at $1 trillion of compounded revenues by 2027, I believe. And this excludes anything related to Grok or any other product for Nvidia. Now, in terms of the revenues, and I believe this is the biggest concern for Nvidia, in my opinion, is how sustainable is the revenue growth, which is highly tied to a lot of CapEx spending from the hyperscalers. If you look at this chart, CapEx spending is expected to keep on increasing, but the percentage of the increase or the pace of the increase is expected to slow down in a major way, which could potentially affect Nvidia's revenue growth, and maybe Nvidia is ultimately peaking in revenue growth. Now, for us to determine that and for us to price in this scenario, because I don't believe Nvidia will still be growing 50 or 70% in 2029, 2030. So we have to kind of price it in from today's prices. And I think the best way to do it is to look at the average PE ratio of the semiconductor index between 2009 and 2018. Because between 2009 and 2018, we had no kind of a major super cycle. We didn't have AI. The internet already kind of played out, and there was a lot of compute early on around it. But there were pretty much nothing exciting, no major cycle. And I believe that could potentially be the case between 2030 to 2034, 2035. So in this period, there's a ETF traded at an average PE of 17 and a half times earnings. And if you look at the growth for Nvidia, it's expected to peak in 2027 at 73%, then decline to 34, 19, 13, and potentially 10% by 2031. The company would be too big, and it will be mostly recurring revenue into new cycles rather than a new cycle expansion, unless we have something major in space or whatever, which is possible. But if outside of that, that's what's expected from Nvidia. And I think this is highly, highly likely. Now, for me to value Nvidia on a case where there's no cycle between 2030 to 2035, so on the worst case scenario, I would be using the 2031 earnings per share, which is 1668, and I believe this is possible. I'm going to time it by the average PE of about 17 and a half times earnings in a no cycle, no excitement kind of phase. I get about $291 per share. If I want to get it double over the next 5 years, or a 15% CAGR over the next 5 years, I would have to buy Nvidia about $145 per share. Today, the stock is trading at $174 per share. So I don't believe Nvidia is overvalued. I think it's fairly valued on the base case scenario. But if you're like me and you want to value stocks on the worst case scenario, I believe anywhere close to $145, it's really hard to go wrong with a company like Nvidia. But with Nvidia's numbers getting larger, the CapEx cycle eventually peaking, maturing, and start to decrease in terms of the pace of the increase in CapEx, all of those things could potentially affect Nvidia. I believe Nvidia will likely maintain their gross margins. They have an amazing CEO. And on the worst case scenario, I see it double in 5 years from about $145 per share. And this is not mentioning potential near-term risks for Nvidia and other semis, which is mainly the price of helium. And helium has increased between 50 to 70% with a lot of the geopolitical events happening within Qatar, which is the world's biggest natural gas field, which produces 30% of the global helium. And I believe helium is used for semiconductors and lithography. TSMC uses them, Intel uses them, and Samsung uses them, and it ultimately affects Nvidia's supply. It could be a little bit short on them, which could increase prices, but still it would be a bottleneck for Nvidia. It could raise costs a little bit. But this is a concern I haven't talked about because I can't really predict geopolitical events. So I believe Nvidia is fairly valued. I think the gross margins are sustainable. I think the growth will decrease. But if you want it on the worst case scenario, we use a 17.5 forward PE, which is mainly the average PE ratio in a no cycle or no excitement phase. And if that's the case, then you get a double from about $145 per share. But Nvidia could potentially deliver much, much more as the CEO keeps surprising and they just keep growing to the upside. So that's my opinion on Nvidia. It was not financial advice. Hope you enjoyed it. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.